Okay, I'm a minute late. Thank you for your patience. I appreciate it. I didn't check in with the Zoom crew. I didn't see anybody logged into the Zoom meeting. But let me double check while I'm right here. Right in the Zoom meeting. That's gonna be assigned. Participants, one, me. Okay, great. So we're good there. Tonight, I'm gonna lecture a little bit on module 8, which takes us right up through the coverable material for the second exam. So this semester's moving along pretty quickly. The second exam will cover modules 5, 6, 7, and 8. The format will be identical to the first exam. And I've gone out into the My Business Courses website that you see here, and I've opened the window. So while I have all of you, I just want to go in here and confirm the timing. So go in here, it looks like I have set that up for spring 2024. It's open. Let's open it right now. It's open. Okay, let's go ahead and make sure we have. Okay, great. Open March 5th as of 5:32 p.m. It will close 2 weeks from tonight on March the 19th at 11:59 p.m. Even if you're half done, the exam will be automatically submitted and you'll receive credit for whatever portion you have done. There's a 2-hour time limit and 1 attempt allowed. Okay, save those changes. So now the exam is officially open. A 2-week window to take that second exam. Anytime during that 2 weeks, it's a 2-hour time limit, 40 multiple choice questions, exact same format as the first exam. So let me start there with questions on the exam, questions on homework, questions on research project. How's everybody doing? Good. Well, there are no questions. We can jump right into it. There we go. Tonight, module 8, we're talking about equity recognition and owner financing. So last week we talked about bond financing. We're still on the balance sheet. Balance sheet's broken out into basic accounting equation. Assets on the left-hand side equals liabilities plus owner's equity on the right-hand side. We talked about liabilities last week, short-term liabilities, long-term liabilities, talked a little bit about the bond market and how those bonds trade from one investor to another investor, and how they fluctuate with interest rates and what that means for a company's credit rating and ultimately the price that they pay on those bonds, which is quoted in interest rate terms. Tonight, we're going to be talking about equity recognition and owner financing, and we're going to be getting at one of those topics that's just, maybe it's just me given my experience set. And I'm sure you've noticed, I have a hyper focus, I'm keenly aware of what management teams get paid and how they get paid. Well, tonight we're going to be talking about how all those owners' equity compensation programs, restricted stock options, and other incentive alignment schemes show up on the balance sheet. So week number one, started with the proxy statement. I said, go out and find out how your management gets paid. And specifically, I want you to know what their incentive compensation is tied to. Is it tied to earnings per share? Is it tied to return on equity? Is it tied to return on assets? Some portion of those over time, when do they vest, so on and so forth. Tonight, we're going to be looking a little bit more closely at those compensation packages and how we record them to the balance sheet. So you'll gather a little insight into how this all percolates up. And there's reasons why all of these things exist. Broadly speaking, they were designed by some compensation consultant to try to get management teams to work a little bit harder. And when they're done right, they can do just that. They can align the incentives of management with the incentives of the shareholders, and everybody wins. But when they're done wrong, you can get a misalignment whereby management's actually being compensated to do something that might not necessarily be in the best interests of shareholders. That's what I'm trying to direct your all's attention to this semester. If we can shine a light on the areas of accounting where that misalignment occurs from time to time, we can potentially identify pitfalls before they happen, or risks before they happen, or opportunities that might give us as investors an area to make a little money, or in another scenario, just not losing money is as good as making it. I like not losing money almost better than I like making it. So let's examine the bottom side of the right-hand side of the balance sheet and look at what we typically see under the shareholders' equity section. So in this instance, we're looking at Johnson & Johnson's balance sheet. When you all go find the balance sheets for whatever companies that you're working on this semester, you're going to see something like this. And equity is never as simple as just equity. When you think about stocks that trade on the New York Stock Exchange, that's common equity. And when you look at a balance sheet, it's never so simple as just seeing common equity. You always see 33 different flavors of equity. And in this instance, on Johnson & Johnson's balance sheet, we have preferred stock, we have common stock, we have accumulated other comprehensive income. We're going to talk about that tonight in detail. And then we have retained earnings. So the two new-ish ones that we haven't talked about in this class yet are preferred stock, and we haven't really touched on retained earnings, although I know all of you have come in contact with retained earnings in your prior accounting class, so let's just get that one away. What are retained earnings? If you're ever tasked in a professional world environment, maybe it's your first day and your boss says, I need you to go downstairs to the basement. The vault is on the right-hand side of the basement floor. Go in there and count all our retained earnings. Don't do that. That's a joke. But it's a senior management having a good time with the first year accounting student, because we all know there's no such thing as earnings that we retain and keep around in some vault. Those actually represent something else. Somebody fire away.
That what you earned on the stock, that's not.
Yeah, you're right.
I mean,
It's so you're looking at the right-hand side of the term, which is earnings. The retention makes it sound like we keep those earnings on hand, but that's silly. We earn the money, then it goes into the bank account, and then we spend it on something else, or we distribute it to shareholders, in which case it's no longer retained. It's a dividend. But we don't actually keep that money in a vault, or it's not physically on hand. We might go out and use that money to buy another company, or a distribution partner, so on and so forth. But it does show up on the statement of shareholders' equity. Okay, tell me a little bit about preferred stock. We have preferred stock on J&J's balance sheet here, quoted without par value. Anybody know what par value is?
Probably is what it's truly valued at. not market value is like what it's selling for.
So
Par value.
market value would be what it's selling for, and then you're 100% right on that. And you might think of that as the economic value, or if you sold it, that'd be the cash you put in your pocket. So par value, last week when we talked about bonds, I mentioned that bonds used to trade in physical certificates. And on the face value of the bond, there would be some face value, usually $1,000 or something, but that wasn't necessarily tied to what the bond was really worth. Well, stocks are similar, but the par value is typically a penny. Sometimes you see it as a dime, sometimes you see it as a nickel. It's almost insignificant. We still print, we don't still do this, but we used to still print the actual paper certificates. And when we printed the paper certificates for Johnson & Johnson, we had to put some worth on them, and we would stamp a penny. So par values, in my mind, have almost become silly, but they still exist in accounting. And we still have to note that every common stock, every share of common stock that we issue has some value. And in this instance, it has a par value of $1 per share. And we've authorized 4.3 billion shares of stock. Of that, we've only actually issued 3.1 billion shares of stock. What's the difference between authorized and issued shares of stock? Why are those two numbers even different?
Authorized is the amount that they can sell, issued is how many's actually been sold.
So we play in yes. We play in a big regulated world anytime that we're looking at publicly traded companies. Johnson & Johnson, regulated by the SEC. So the SEC wants to know what Johnson & Johnson's doing. They say, we're gonna give you access to these markets, but in exchange for the world's most liquid markets, we have oversight responsibilities. When we promise to keep these markets safe, and in doing so, we attract investors from around the world. So if you play by our rules, you're gonna have superior access to capital. So Johnson & Johnson agrees to play by the SEC's rules, and in doing so, they have to ask permission before they can issue new shares. So when they ask permission, the SEC will authorize a certain number. And typically that number's a lot, you want that number to be as high as you can possibly get it. So you don't have to go out back and ask the SEC for permission every time you want to issue a new shares. So Johnson & Johnson has permission to issue up to an additional 1.2 billion shares of its company. It's probably gonna last a long time. They could upsize the company by almost a third before they have to ask the SEC for more permission. Okay. Let's look at this last line item. You notice that it's offset a little bit. These first four, you could think of that as a gross calculation of all the equity. And then we have this term that's offset, which is a subtraction from the gross amount. And we're subtracting something called treasury stock. If you encounter treasury stock, somebody give me a quick definition of treasury stock.
The stock that's been issued, but it's been repurchased or taken back from the company.
Yes, yes, and yes. So periodically, Johnson & Johnson or whoever will go out into the public markets and they will buy their own shares back. Why? Why would you do that?
To maintain ownership. Their majority ownership.
It's as simple as that. Whenever you buy something, anything, you think that it's of value. Okay. So the signaling theory says that when a company like Johnson & Johnson, whose management team ought to know better about what the stock is worth than anybody else, because they manage the company, so they ought to know what it's worth. If it's trading for $90 a share, and they think it's worth $150 a share, buy that stock hand over fist. You buy as much as you can possibly buy. So the signaling theory says that active company stock buybacks is an indication of value. Okay. I agree with that, but I also start the semester off with a careful study of the proxy. Because as we also know in this room, management might be looking at something else. And if the something else that they're looking at is earnings per share that triggers the next tranche of their stock options to vest. Pretty quick and easy way to boost your earnings per share is by decreasing the denominator of the ratio in earnings per share. Shares is the denominator. If you go out and buy shares back, you're lowering that denominator and increasing earnings per share. So earnings per share is one of the most common measures that companies tie themselves to for incentive comp. And if it's no more complex than that, then this basic maneuver of finance, these stock buybacks, can get you paid rather easily. So let's be on the lookout for that as we go through this. Preferred stock, common stock, par value offer is issued. We just talked about it. One of those terms. Accumulated other comprehensive income. I'm going to talk about this in a few slides. Retained earnings, treasury stock. Yes. Okay, book value per share is a simple term, and I don't want to overcomplicate it. It's when you hear the term book value, I want you to just think balance sheet. What's, the book means company books and records. So their books and records are simply their financial sheet. And what are we talking about here? We're talking about the balance sheet. So book value of equity per share. So this is, you can just think of this about shareholders' equity minus preferred stock divided by number of common shares outstanding. This is a term that is important. So, excuse me. This says net book per share. Depending on your use case, remember this is finance. This is a finance class, not necessarily an accounting class. And I make the distinction because with most accounting classes, we're subject to GAAP, general accepted accounting principles. And that's a strict set of rules. When we get into talking about ratios like book value per share, we are clearly in the realm of finance. And how you calculate book value per share or any other ratio is primarily based on the use case. What are you trying to do with that? So if you're a common shareholder and you want to know book value per share because you own the common, well, you might subtract out the preferred stock. And what you're calculating there is book value per common share. Okay. But if you're another corporation thinking about buying this firm outright, you might be looking at buying out all of the common and the preferred shares, in which case the relevant number for your use case becomes all equity, not just common, not just preferred, but all equity. So our authors don't really draw that distinction here, but it's important, and it's important every time you look at a ratio to say, okay, what's the use case? How am I using it? How am I using that to inform my opinion? And you run into that periodically. Our authors are, I don't know what's the rule. They strictly play by the rules in a lot of cases. One of the distinctions that I draw when we're in module 3, I don't think I drew that out for this group, but oftentimes you'll see the authors look at a balance sheet number in the denominator and compute an average. So return on assets. Well, you know what the return is because that's on the income statement. That's earnings. Those earnings were earned over a period of typically 12 months. So the denominator is a balance sheet number. And balance sheets are reported as of a certain date. So if you calculate 2023 return on assets for Johnson & Johnson, you have 2023 net income divided by the assets on 2023, December 31st, 2023, or January 1st, 2023. The authors will encourage you to compute an average denominator as a more accurate number. And they're technically right. But remember, this isn't a accounting class, this is a finance class. And as use cases go, I've never seen anybody compute an average. Common industry standard is just to grab the most recent asset number from the balance sheet and use that in your denominator. It's your job as the analyst to recognize your use case. And if that works for you, great. If the numbers aren't significantly different, if there haven't been any acquisitions, if the assets didn't materially change from one date to the next, then you're not gonna have any problems. If they have, you might need to make an adjustment, which is one of the other key learning objectives of this class. We have to recognize when the accounting as printed is an accurate representation of economic reality. And when we as analysts have to go in and tinker around and say, well, you know, this accounting is a little bit off for what I'm trying to use it for, I need to make an adjustment. And every module we look at, there's a slide that I'll pull up that describes how an analyst would make adjustments. I think last time we were talking about, oh, I don't remember what we were talking about last class. We were talking about warranty expense, and I think it was Harley Davidson. And we looked at Harley's warranty expense over the last 3 years. And if there's been any variability in those numbers, the authors of the text were advising all of us as analysts, just make an analyst adjustment. Assume that warranty expense was an average of the last 3 years. Smooth out that volatility. Use that to project the future. And when you use that adjusted warranty expense to project the future, you're gonna have a better representation for gauging whether or not management's current estimation of warranty expense is reasonable. So here's the statement of stockholders' equity again for Johnson & Johnson. Find this for the companies that you're looking at this semester and make sure that you understand all the terms. Typically, what you're gonna see is a beginning of period date and an end of period date, and any fluctuations that occurred during the period attributed it to the major categories of shareholders' equity that we just looked at. And by and large, they all break down pretty similarly into preferred, common, treasury stock, and accumulated other comprehensive income. And you can see that how they vary from year to year. And hopefully there won't be any big surprises on here. I didn't really put a lot of time into J&J's, but you can see they started the year at 60 and they ended the year at 59. Okay, so, well, the first thing you notice is they're going in the wrong direction. So that's the first thing that pops into my mind is, well, how come they're going in the wrong direction? You want to see your equity go up. So let's analyze this a little bit more closely, and we'll just pick on the biggest number here. The biggest number is net earnings. Okay, great, they were profitable. How come their equity didn't go up? Because that net earnings, it flows through to retained earnings. So net earnings, that net income on the income statement, that flows through to the balance sheet, increases the retained earnings column. Okay, so now we got to go looking a little bit further for why this number went down. Well, the biggest negative is cash dividends paid. Okay, that's not necessarily a negative. If we as shareholders are getting paid, I like that. I like cashing checks, so I'm not gonna take too much of an issue with cash dividends that are getting paid. And you can see the cash dividends actually show up as a deduction to retained earnings on the statement. Okay, what about this $5 billion number? Repurchase of common stock. Okay, well, so we took cash and we bought stock back. So that's a good reason, maybe good reason. We just talked it through. Let's give J&J management the benefit of the doubt in this instance and say, okay, they're putting cash towards buying stock back. That should decrease shareholders' earnings. And now we've explained the major muscle movements. We also had some stock options plans and a couple of It's something called cumulative adjustment, which posted to retained earnings and other accumulated comprehensive income both. We don't know what that is. If you're looking at a statement of retained earnings and you see a big number here, you're gonna have to go dig a little bit deeper to find out what the heck is going on with that number. Now you're digging into the fine print to better understand what cumulative adjustment means and why half of it hit retained earnings and half of it hit accumulated other comprehensive income. Whatever I did, PowerPoint machine didn't. Okay, convertible preferred stock. This was not on J&J's balance sheet. We've switched companies. And we've identified what would be, I think this is our 5th category of shareholders' equity. In this case, we do have a flavor of preferred stock, but it's new. We're looking at Corning, I think. Yes, Corning's preferred stock, and in this instance, it's convertible. Okay, what do we know about convertible? Last week, we talked about a convertible bond. Remember how that worked? Or maybe we didn't talk about that. I get everything's mixed up. Maybe that's here in the slides.
At a certain price, you're allowed to have the option to switch over your preferred share to a certain amount of common shares.
It's a nice feature for investors. It usually offers investors flexibility. What do investors offer back in exchange for that flexibility?
Their market value, the preferred shares don't change. They only have dividends.
Could be. There's always a trade. If we're talking about a bond and the company gives a conversion feature, in exchange for that conversion feature, which is valuable to bondholders, they'll typically give the company better terms on the collateral or a lower interest rate. So the company kind of goes through this dance with their underwriters, Goldman Sachs, Merrill Lynch, Morgan Stanley, to negotiate terms between what Goldman Sachs thinks that they can take to the bond market and sell $1 billion issuance to bondholders, and what they think they need to give back to attract these investors to that exchange. So in this instance, we're looking at convertible preferred stock. This convertible preferred pays an annual dividend of 4.25%, not terrible, not great. And the second bullet point on the slide says it includes a conversion option that allows the preferred shareholders to exchange 1 preferred share for 50,000 common shares. That seems like a lot. I haven't done the math, and I don't know where Corning was trading at this particular time, but the 50,000 common shares is going to set a floor, basically, for what that preferred is worth. And everybody that buys and sells stock in the stock market can do the math. And that's gonna inform their decision to buy Corning or not buy Corning, and you're gonna see that preferred stock basically trade at 50 times the common stock, or maybe probably more. What's that? If it trades at 50,000 times the common stock, or more, nobody's gonna convert it. But if it trades at 40,000 times the common stock, then you're gonna convert it, sell it, and you will have immediately made 25% on your money. So that's how those two things are tied to each other and how they will ultimately trade together. Okay, J&J Common, talked about par value. Par value has no relation to market value. I'm just making sure I hit on all these points already. Issued, authorized. Yes. Okay, and we talked about treasury stock, outstanding shares. We didn't talk about market capitalization. It's a pretty simple term. I want to make sure that everybody in this class has a good understanding of it. At its most simplest, we're just taking the number of shares outstanding, so actually issued less any treasury stock is what's outstanding. And we're multiplying that times the price per share. theoretically, what you get when you do that is if you were to, take your wallet out and, or write a check for the value of the company, if you were gonna go buy 100% of the shares outstanding, which would make you the sole owner of the common stock, that's the market capitalization. Now, in theory, you could do that, but once the other shareholders got an understanding that you were trying to take control of the company, they would bid up the shares and you'd end up paying a lot more than the current market capital. That's called a control premium. And control premiums are valuable. If you want control of a company, you're gonna have to pay more than what you would otherwise pay for just a small minority interest, i.e. 1 share or 10 shares or 100 shares. If you wanna accumulate 100% of the shares outstanding, you can plan on paying 120, 130, 150% of the current market cap. This is a tricky one. Non-controlling interest. When you look at your income statement and balance sheet, I would speculate that most of you are going to see income attributable to non-controlling interest. That happens when you have conglomerates, when we're talking about companies that have been around for 50 years, they've bought and sold businesses over the course of that time that might number into the dozens, maybe more. And those deals are not always a simple outright purchase. Sometimes you buy 20% of a competitor and then maybe 3 or 4 years later, you'll buy another 50%, and maybe 3 or 4 years later, you buy another 10%. And you might own 95% of that business, but there's still 5% of that business that's owned by somebody else. That means when we consolidate the financials, and we haven't talked about this yet, but when you consolidate financials, you basically add 100% of the revenues of one firm to 100% of the revenues of a second firm, and you merge it together. We're getting ahead, this is model 10. But when you do that, you're acting as if you own 100% of all subsidiaries. So you go through this process and you get to the bottom of the income statement. And GAAP forces you to recognize that, hey, we don't own 100% of all those subsidiaries. There's 5% of those earnings that are actually attributable to somebody else. And we call that a non-controlling interest. And it shows up on both the income statement and the balance sheet. And insofar as this class is concerned, it's about as simple as understanding that conceptually. There might be a homework problem that asks you to work through that, but I don't expect there to be much beyond that on the exam. If you understand it conceptually, should be pretty good. Here's how that looks. The General Mills is the example in this case. We have the shareholders' equity statement again, and then we have total stockholders' equity. On the balance sheet, you're going to see non-controlling interest. On the income statement, you're going to see income attributable to non-controlling interest. And that income is going to flow through to the non-controlling interest section on the statement of shareholders' equity. Now, this will, so our author's note down here on this final bullet point, that measure of equity will be used for business analysis. So again, it's use case just dependent. Return on equity, are we using total equity or total stockholders' equity? You can make the case for either one. Most often, you're going to see return on equity, whereby the equity is total stockholders' equity. So like equity attributable to common, it would not include the consolidated equity. Leverage ratios, you have to be mindful of those. Debt to equity, market to book ratios. Or again, are we using the book value of common equity or the book value attributable to what would be less non-controlling interests? Use case dependent on all of those ratios. Okay, let's look at stock issuances and repurchases. When we issue a stock, we have to make sure that we're checking all the boxes. So we're going to have a, you move that banner there, you can see. So we have stock. We have the par value, which will be recorded on the balance sheet as we've observed. Then we're gonna create a line item. We're gonna create an account to fill in the gap. Par values of a penny, a nickel, a quarter, a dollar, whatever. We have this printed sheet of paper. We have the par value, but we're gonna go sell that for something, hopefully, fingers crossed, way in excess of par. And when we do, we're gonna create an account that's just that simple, that says additional paid in capital. And that's the difference between par value and what we actually sell that for. Goes smack dab on the front of our statement of shareholders' equity. Go past the slide. if I can. And it's gonna show up on our balance sheet like this. In this instance, J&J issues 1,000 shares of common stock with a $1 par value for $100 per share. So we're gonna credit common stock for $1,000 and we're gonna credit additional paid in capital for 99,000, and those two add up to the 100,000 that we received in cash. Cash becomes the debit entry to balance that transaction. And they record to our balance sheet and income statement, just as our authors have noted there. Pretty simple. Fast forward a few years later, J&J decides that their stock is a significant value and they're gonna buy some of it back. So they take $18,000 worth of cash and they go buy $18,000 worth of what now becomes treasury stock. Elizabeth, yes.
How does stock splits work? So,
It's like
Is
3
that
slides from now. Yeah,
okay, sorry. I'm
Yeah,
jumping
great-
in.
great question. Basically, how they work is, typically it's a non-cash transaction, so you just kind of end up cutting the pie into more pieces.
Right,
So you don't get any cash in exchange for a stock split.
so,
The transaction only affects your equity.
okay,
So the number of shares immediately doubles if it's a
right,
2 for
so
1
if
split.
they're authorized to have 4 million shares, and they're at 300, or, sorry. They're authorized to have 4 million shares and they've already sold 300, or, damn it, 3 million.
Yeah,
Sorry, and there's 3 million issued, so then how does the stock split work if they're only authorized to have 4 million? Then,
when you take your own share count, cut it into more pieces, it doesn't affect what you're authorized. So
Okay.
like if you're still authorized to an additional 1.3 billion or
Whatever,
whatever
yeah.
changes. So they kind of.
I just wasn't sure how that worked with the authorized amount of stock that they would have if they,
Yeah, that's a good question.
Stock split.
You're not running up against a cap typically with the SEC
okay,
when you do a stock split.
okay,
Cause there's varying opinions about it, but it's kind of a nonsensical transaction anyway. If you take a pie and cut it into 6 pieces or 12 pieces, you still have the same amount of pie. So why ever even do a stock split?
Isn't there some kind of advantage to lowering the price of your stock?
So that's the theory. So we can argue about that. The reason why Wall Street would argue that there is an advantage to keeping your stock in a certain range. The pro argument says that creates liquidity because you're gonna attract, like, take Berkshire Hathaway. A share of Berkshire Hathaway stock trades for $400,000. How many people in this room can afford to buy a share of Berkshire Hathaway? Don't answer that question. Obviously, there's gonna be a lot more buyers for a stock that trades at $40 than there is for a stock that trades at $400,000, and that liquidity is valuable. Okay. Now, skeptic would say Wall Street had to think pretty hard to come up with that rationale because they get paid every time you do a stock split. So they're incented to make sure you keep your stock price in a certain range because there's fees associated with all these Wall Street transactions. You know, why did Warren Buffett let his stock price get to $400,000 per share? Because he obviously takes the other side of that argument and said, well, this is silly. I'm not gonna pay Wall Street bankers to come in here and do a nonsensical transaction. I don't know that there's one right or one wrong, but that's the two sides of it.
doesn't he own a majority of Berkshire Hathaway though, so, I mean, it just increases.
Yeah,
I mean, it would
he's thinking like a true owner. If you truly owned the business, well,
Why would you stock split it so more people?
it does kind of sound so. But if most CEOs don't truly own the business. And if you look at CEO pay in general, aside from incentive comp, just look at their comp. The bigger companies get, the higher, I guess the more CEOs make. So it's so common to see this. CEOs will engage in merger and acquisition activity for the sake of size, rather than for the sake of creating value for the shareholders. So if I can take a $10 billion company and turn it into a $20 billion company or a $50 billion company by borrowing a bunch of money from Wall Street and just buying up disparate entities, I'm going to increase my own pay because I'm going to go back to the board of directors and I'm going to say, I'm not being paid fair. And this compensation consultant that I just hired validates that because they're comparing my compensation to all the other companies of similar size. And this works almost every time. And then the CEO's pay goes up. Then you get some company like Tyco and Dennis Kozlowski that's pieced together 100 different entities that make no sense being together, and you hire the next CEO and they decide, well, we need to divest of all these companies. So first you put it all together and then you tear it all apart, and there's no real financial synergy to any of it. And that's what we're trying to get to the bottom of, is having an understanding of the accounting that allows us to say, shenanigans, I don't buy it, leave me a line. Okay, reselling treasury stock. Okay, let's say J&J did their job. They went out, they spent $18,000 on treasury stock. It was undervalued, and a year later, they sell that same $18,000 worth of treasury stock for $19,000. It's exactly the way buybacks are supposed to work. The signaling is real in an instance like that. They saw that their stock was undervalued, they bought it back. Later, the market realized the same thing, the stock appreciates, and J&J says, great, let's sell it back to the market. They just profited $1,000, and that shows up in the additional paid in capital line item. The $1,000 becomes the plug figure, and in effect, pure profit. Yeah, I don't need to talk about anything. Okay, sometimes a company will quote unquote retire treasury stock, and that means that they will forego the opportunity to subsequently sell that back to the market and just say, well, this is retired, it's doesn't exist. And when they do that, they just remove it from the statement of shareholders' equity altogether. Common stock is reduced for the par value, additional paid in capital is reduced for the difference between cost and par, retained earnings is reduced for any remaining difference. I don't see this very often because it limits the company's flexibility. Because if they have it on their balance sheet, they can resell it. If they retire it, they don't have it to resell anymore. It would just be for the optics of removing that treasury stock from the balance sheet. But you know, I see that as another kind of nonsensical transaction too. I don't identify much benefit to it, but it does happen periodically. So you all need to know how it's accounted for. Okay, here's another one of those adjustments. Stock buybacks have increased dramatically. We can argue about why. If the signaling theory is correct, that management recognizes an opportunity, a buying opportunity when they see it. And we know that stock buybacks have increased dramatically. That would argue that the market as a whole is fairly undervalued. Maybe, but if you look at historical ratios, like if you look back over the last 50 years, the average price to earnings ratio of the market is around 15. So if the argument is that stock buybacks have increased because the signaling theory is correct, then the market as a whole would probably have been trading at less than 50. It hasn't been trading at less than 50. It's been bumping up around 20 for almost the last decade. I have a really hard time believing that the market as a whole represents value as compared to history. Which begs the question, why in the world have stock buybacks increased so dramatically? It's because management teams use stock buybacks to manipulate their own accounting and their own ratios, and they do it for other reasons that don't have anything to do with the signaling power of a stock buyback. Okay. Periodically, when those stock. Lost it, it's only 6:17. I was in a mediation all day, it just absolutely tore me up. Where we got this outstanding dispute, but you don't need to know about dispute, it's a lawsuit. And we're to the point now where we're like, okay, let's just see if we can settle this thing before it goes to court. So it's me and my two partners and our attorney. And we're in one room. And our adversaries or counterparties are in another. We've got this mediator. It's going back and forth all day long. We don't actually talk to the people that we're in disagreement with. We're actually like coordinated on. But the attorney for the counterparty agreed to host the meeting. And I don't know if this was a brilliant strategy move or just a jerk move. But they kept us going all day long with no lunch, no snacks, no, we had one pitcher of water, that ran dry about 10:30 this morning.
I would have DoorDash something from.
And the mediator just went back and forth all day long, back and forth all day long. And mediators, I have a new sense of appreciation and awareness for what it takes to be a good mediator. Like when you go to mediator school, I'm pretty sure day one is all about just being a good old boy and building rapport with whoever it is that's sitting on the other side of the table, because you want them to like you. You want them to understand that you've worked hard to do deals all your life, and you're gonna go back and get an unreasonable offer from the guys on that, and you talk about your common belief that they don't know what they're talking about, and vice versa. I had to leave, but we were in there for 8 hours. It started at 9 and we went straight through to 4:45. I'm like, I gotta go teach. So I don't even know how it ended up. We were a little bit closer when it ended up than when we started, but at any rate, I'm a little scatterbrained. My apologies. So we're talking about buybacks, and buybacks are so inflated that you'll see weird things happen with the balance sheet. And one of those weird things that can happen with the balance sheet is for there to have been so many buybacks that the equity on the balance sheet now shows up as negative. Negative equity doesn't allow you to compute a return on equity number. And when you can't compute a return on equity number, well, you've really kind of hobbled yourself when it comes to using one of the most common tools, one of the most common ratios, one of the most common ways to communicate in finance. So as analysts, we need to recognize, that's a scenario that can happen. Here's the playbook that we use when we see that. If we want to calculate a return on equity, we're going to have to go back in and, well, you can see exactly how the authors have walked us through that here. You have net income, you have negative equity, you have average equity, and then you have return on equity using average equity. Well, return on equity using average equity is negative. So let's look at the treasury stock, recalculate the equity without the treasury stock. Effectively, we're reversing all of those buyback, thank you, Thank you. All of those buyback transactions that have posted for whoever knows how long. And once those are reversed, we can recast the financial statements in such a way that this return on equity might become meaningful again. And there again, use case, whether or not these numbers mean anything are all about the use case. So for that to have real meaning, you need to understand what's in that treasury stock number and the period of time that it posted to the balance sheet. If all this treasury stock was based on one purchase that happened last quarter, then when we reverse it and recast these financial statements, that means a lot because that was a recent transaction and we can reverse it pretty easily because the stock price hasn't changed that much. And when we reverse it, it's almost like we're reissuing those shares back into the market in exchange for cash. We could also adjust the cash on the balance sheet. And that gives us a different perspective on basically the exact same company. If that treasury stock is accrued over a period of 10 or 20 years, this exercise might not be as useful. Okay, we can do the same thing with return on equity, if we wanted to use market value. We could just substitute the market value in exchange for the equity on the book. That's something entirely different, but it's still meaningful data. Okay, let's get into stock-based compensation learning objectives. I mentioned that there are several reasons why you might actually do this. At its core, we're trying to increase employee attention, incentivize management teams, hopefully align them with what's in the best interest of shareholders. And this is a great slide. Slide number 25 probably hits on the most popular incentive-based compensation methodologies that you all have uncovered during your proxy research report. So you probably saw some version of, or some combination of restricted stock units, employee stock options, stock appreciation rights, employee share purchase plans, so on and so forth. All of these are different ways of getting your employees and management teams paid. The only difference is timing and how closely they mirror straight up common stock or something that's linked to common stock, like a stock appreciation rights. So stock appreciation rights don't give management teams stock. That's not stock. Don't ever think it's stock. Usually doesn't come with any voting rights, and it doesn't give you any basis upfront, meaning upfront it's typically worth nothing. We give you a promise, we give you a piece of paper, and we say this piece of paper is going to be based on the value, on the delta between what the company's worth today and what the company's worth maybe 3 years from now, 5 years from now, 10 years from now. Any time period can be identified by stock appreciation rights. So if on day one, when you're employed, you get stock appreciation rights and the stock's trading for $100 a share, and then by your third year in business, it's trading for $200 a share. Well, there's $100 in value there. You were along for that ride. You don't get $200 per share, but it's appreciated by $100 per share. So your stock appreciation rights are worth $100 per share. The theory there is, well, we want to give you credit for anything that you helped deliver. And during that period of time, your efforts were partially accountable for the stock price appreciation. So that's just one example of how you can structure a whole multitude of different compensation plans. When you're out in the real world, you're typically going to hire a consultant to walk you through all of these different options.
How you cash out a stock appreciation?
It's great. That's a great question. You cash out of stock appreciation rights by reading the contractual language associated with stock appreciation rights. And
So basically,
there
it's like,
might be different language for every company that we're looking at this.
circularly mean nothing. It's like, hey,
Yeah, think of this as like a category of incentive compensation. And then, I don't know, it's like this. like the animal kingdom, you know, pick a genus or how many species are inside of a category. You know, every single one of these might be different from every other stock appreciation rate. But broadly speaking, they have similar features, and the similar features are gonna be a strike price that's different from the value of the stock. And then incentive that's linked to the appreciation over a period of time, and then all of the details can be substantially different. That's a good question, and it's a good question because it forces us to recognize that there's no standard template for these, only broad categories with similar features.
Could those stock appreciation rights be paid out as like quarterly sales bonus or something like that? A quarterly bonus?
Yeah, like. So. If you hit X, Y, Z in sales, we're gonna give you another 50 stock appreciation rates. That could be the basic give and take. But in effect, the stock appreciation rates become your bonus rather than cash.
So what monetary value do they hold? That's where I'm confused.
Well,
Like, if I wanted to cash out my stock on a,
yeah, so
On
that's
a-
the very next slide, expense recognition. What are those things worth? Well. So you ask the question from the other side of the transaction. What are they worth as the employee? When I get stock appreciation rights, what are they worth to me? What could I sell them? Okay, well, the company has to ask that question too, because if I'm the company and you're the employee, when I issue stock appreciation rights to you, I've just issued something of value. Whenever I engage in a transaction where I have something of value leaving the company, I have to record an expense. It's just the accounting. So the company is interested in what those are worth too. Now, we may have different opinions about what they're worth because GAAP puts a framework in place for companies to value those so that they can put them on their financial statements. They may be associated with a vesting schedule that's 1 year, 3 year, 5 years, what have you. So on day one, they may be meaningless. But that doesn't mean the company won't record them as some kind of expense on the balance sheet. And where the company's gonna use an option pricing model typically, or like a Black-Scholes model. So let's see a couple heads nodding. We don't cover the Black-Scholes model in this class, but it's probably been in your investment class. And if you haven't taken investments yet, it's a simple way to calculate what a future option is worth. So you look at what it's worth today, and if it's worth 0 today, then there's no expense for the company. And you look at the volatility associated with the underlying investment, and you calculate the likelihood that could be sold at various prices in the future. And then you discount that back to time series. We don't need to understand how the Black-Scholes model works specifically in this class. We just need to know that there is such a thing as an options pricing model, and we're going to use that to determine the value of the options plans we issue to employees, and we're going to post that on the balance sheet. Here's the rules for doing that. We record that expense at its fair value when issued. And those two things are fair value is what we use the Black-Scholes options pricing model to determine. And then the when issued, that's not difficult to determine. When issued is when we post that to the employee's account.
It needs to be accrued as well.
They can be. So if there's a vesting schedule associated with an options package, typically the company won't expense it until the vesting period ends. So that's part of the when issued. So I just made it sound like the when issued thing was a simple matter to determine. And as you point out, it's not necessarily always so simple, because it might vest over 1, 3, 5 years sometimes. Okay, Johnson & Johnson consolidated statement of cash flows. this can get a little bit tricky because most of the time, these incentive comp plans are not direct cash payments. So you'll see this used in practice. If we're valuing a company based on its cash flows, the temptation is for analysts to say stock-based compensation plans are not cash flows. They're not direct cash outlays, and therefore we can exclude them from a discounted cash flow analysis. Caution, throw up the caution flag with that. Because to exclude them from a discounted cash flow analysis would argue that they have no detrimental impact on the valuation of the company. And that's an overly simplistic way to look at these things. We should all recognize that they don't require an initial cash outlay. But we should simultaneously recognize that there's almost a near 100% certainty that they will be exercised at some point in the future, which means that that shareholders' equity pie is now getting carved into more pieces. So my share that I bought or valued today is not worth as much in the future because these obligations exist and they're outstanding.
Is that like an employee stock option when you first start somewhere?
Yeah, so, I used to have an employee stock option plan at Sprint, this is way back. 2000, no, before that. 1998. It was. I was working for Sprint PCS at the time. We were working on the coolest project you could ever possibly imagine. We were getting ready to put the internet on the phone. So, and we had a stock options package associated with that. It was called an employee stock options program. And every quarter, in lieu of a paycheck, I could say, I don't want you to actually pay me. I want you to give me stock. So rather than getting paid every 2 weeks, I would get paid once a quarter. And I would get paid in 100% stock. And there were no restrictions associated with this. And trying to remember if, yeah, I figured this out on my own because they gave me the employee stock purchase plan and I read it. Well, come to find out, most employees don't actually read these things. So maybe I was hardwired to be an analyst from day one. So when you read the fine print, you come to understand the way these things are built and how they run. Well, I had an opportunity to defer up to, I think, $85,000 worth of myself. Well, I was only a third or fourth year analyst. I wasn't making $85,000 a year yet. So that was 100% of my salary. And it was set up so that I could buy that at 85% of the purchase price. So they had set it up to try to incentivize employees to buy stock because they wanted more employees to be stockholders. Okay, great. If you're going to give the employees the opportunity to be stockholders and let them buy the stock at an 85%, effectively a 15% discount, 85% of market value, that ought to do it. But there were no other restrictions about how long they had to sell it. So my aha light bulb went off and said, well, that's a 15% raise. I'm just going to put all my paycheck into this program. I'm going to get stock at the end of the quarter. I'm going to sell it the next day. And I just made 15% on everything else I would have cashed out. So I did that and it worked great. And then I started to notice something else, which I was not evidently the only employee that had figured this out. Because if you tracked the way that the stock moved around the end of the quarters, you could see that we would lose a few dollars in price per share at the end of every quarter. I'm like, that's all the employees flooding the market with those shares. I'm not the only one doing this. So now not only do you have the opportunity to buy and the opportunity to sell at a 15% discount, but if you wanted to short the stock and make a few dollars watching it decline a couple, you could do that too. And when I think I might have been a student at UMKC. I did a graduate program in just business, and then I did a separate graduate program in accounting, both here at UMKC. I was in Dr. Clark's, one of his first classes, and I remember when he and I were talking about this. He might have actually wrote this up as a research paper as a result of my experience working with employees on purchase plans, because that represents a market inefficiency. If what I'm describing is true, then you can make money in the market without actually having any dollars at risk. And that makes for a great academic paper. And I know he looked into it. I don't know if he ever actually published it, but at any rate, that's an aside. So you see your stock-based compensation down here as reported, as calculated from your Black-Scholes options pricing model, but not cash flows, just an expense that shows up. And here's the discussion of whether or not that is actually a cash flow or spendings. Oh, geez, I only got 7 minutes left. I gotta hit. Okay, I'm gonna skip cash dividends and stock splits because that's some of the simpler material in the module. And I want to get to the components of accumulated other comprehensive income as the final topic of the night. Accumulated other comprehensive income is what I call the basement. When you look at the income statement, you have revenues, you have expenses, you have earnings before interest and taxes. You have interest, you have earnings before taxes, you have taxes, and then you have earnings. Okay. Net income. Net income flows through to the balance sheet as retained earnings. Well, FASB says that there are areas of accounting that are so volatile, they would otherwise distort the income statement to such a degree as to make it useless. So they created a whole other category of profits and losses, income, that they call other accumulated comprehensive income. And this is below net income. So what's below the bottom line? Well, nothing's supposed to be below the bottom line it for me, you hear people say. Well, in accounting, bottom line is just an estimate, because there's a whole category of junk. And you can think of this as the basement, or sometimes I'll refer to it as the junk drawer of other stuff that is meaningful. It can have a huge impact on the economic value of the business, but we throw it all in the junk drawer. And we throw it all in the junk drawer because it's so volatile. And it broadly breaks down into gains and losses from foreign subsidiaries. You'll recall that at the end of the year, if we're Apple and we do business in 100 companies nationwide, and we have to report our balance sheet on December 31st, well, you don't see a balance sheet in dollars and yen and yuan and renminbi and the euro. Apple does business in all 5 of those currencies. How do they count their cash at the end of the year? Well, they figure out how many euros they have, and they translate that into dollars. And they print that number on the front of their balance sheet. But they don't actually translate the currency. They still have the euros. They've just gone through an Excel spreadsheet exercise and calculated it as if. So those numbers aren't real, they're representations of what those assets are worth if they all got translated into dollars. And you all know that the value of the dollar fluctuates wildly relative to every other currency in the world. So when you make those translation adjustments today, they're going to be different tomorrow and the next day and the next day and the next day. The balance sheet is printed as of a single date. So at year end, we're translating the value of all those assets, and that can be wildly different than it was the year before. So translation adjustments, which can be huge, are reported in other comprehensive income on the theory that over time, sometimes you're going to make money on that translation, sometimes you're going to lose money on that translation, but on the whole, it's going to average out. Maybe that's true, but if I send you over to the econ department here at UMKC, you're gonna get to listen to another full semester's worth of material talking about how these global exchanges move for other reasons that have everything to do with commodity supplies and monetary policy and geopolitical influences and so on and so forth. And you can make a real career out of predicting global exchange rates. So maybe it's true, but sometimes it's not. And if it's not, then all of a sudden, these translation gains may have real value. And depending upon where Apple's primarily doing business and expanding into new markets, you might be able to take some of that insight and put it to work in a month. Employee benefits plans, touched on this earlier in the semester. I always use the example of my grandfather. He works for Phillips 66. He passed away in 2002. He worked for Phillips 66 from 1950 to 1985. So he put in 35 years, and as a result of his time working for Phillips 66, he accrued a pension. And a pension is a promise from Phillips 66 to pay him throughout his whole life and his spouse, surviving spouse in that instance, throughout her whole life. So Phillips 66 accrued a liability to pay my grandfather from the date he retired in 1985 to the date he died in 2002, and then to continue paying my grandmother from 2002 until, well, she turns 92 later this month. So that stream of cash flows has been ongoing since 1985. And Phillips 66 has to put that on their balance sheet. Okay, so that obligation for companies the size of Phillips or Chevron or Exxon can be in the tens of billions of dollars. And if you're managing that prudently, you accrue 10 to 20 to 30 to 40 billion dollars to pay those future liabilities, and you give it to a professional to manage like myself, and we put it in the stock market. That's generally thought to be a pretty prudent process until you hit a market like 2007. And that $10 billion portfolio drops to $5 billion portfolio. Well, imagine trying to run a $5 billion loss through your income statement. You know, 2 years ago, you made 10 million. The year before that, you made 12 million. Last year, you made 13 million. This year, you lost 5 billion. Next year, you're back. You just useless. So we put that down here in the junk drawer. Other gains and losses on equity securities, if we happen to hold those go in the junk drawer. Gains and losses on derivative hedges, those go in the junk drawer. Good example of this might be Southwest Airlines. They buy so much jet fuel, they need to hedge that out over time, and sometimes they'll do that for a period of 3 to 5 years into the future. Those hedges can fluctuate wildly. We put those in the junk drawer. And then you'll see a reconciliation of all this in the back of the 10K, just like with everything else. Find this table, understand what's on it, and dig into the fine print if you need clarity. And we are at time, which is okay, because I made it through 90% of what I wanted to cover tonight. Objective number 6, it takes a deeper dive into those convertible securities, which we talked about earlier in the class. So that's all I got. Thanks, gang. Test is open. Good luck.